Welcome to Catalyst. I'm Madison Mills. 30 minutes into the trading day. Let's get you the three catalysts we're watching this hour. First up, can the market rally continue as the first U.S.-China trade talks since President Trump imposed 145% tariffs on the world's second largest economy? We break down where things stand. Plus, Fed officials return to the speaking circuit, warning on tariffs and anchoring inflation expectations. We'll bring you the details. And we speak to DraftKings CEO Jason Robins after the company's earnings print and break down why March Madness weighed on the results. Half an hour into the start of U.S. trading, let's get a check on the markets brought to you by Tasty Trade. Looking at gains across the board off the back of this post from the president on Truth Social that there are many trade deals in the hopper, all good or great ones in parentheses here. The president also posting that we could see an 80% tariff on China as administration officials are set to meet with Beijing officials over the course of the weekend here to discuss those trade deals. News of those deals, among other individual news, moving the markets higher this morning. But let's flip over to the bond market for a look at what's going on there, because yields coming in just a touch. You've got your 10-year down about a basis point, your 30-year yield down about 2 basis points this morning. And finally, looking here at Bitcoin holding above that 100,000 level, up over 4% here. Interesting, off the back of some legislation that may not be viewed as hyper positive for cryptocurrencies, but maybe some deal making, some individual company earnings lifting Bitcoin this morning as that risk off sentiment does continue to take hold on this market, at least for now. Well, I want to bring in my co-host for the hour, Peter Tchir, Academy Securities Head of Macro Strategy. Peter is going to be here to give us insights throughout the hour. I'll ask you questions. You'll ask our guest questions. It'll be great. But Peter, I want to start on something that you pointed out this week, which is that the news on China chips and this administration's approach to chip curbs was a bigger deal than we might have initially made it, at least in financial media circles. Talk to me about why you see that as a catalyst.
Yeah, so I think, when we had FOMC day, Trump initially tweeted something about China tariffs, things weren't going great. Then all of a sudden he came out something on chips and maybe reducing some of the restrictions on chips. Then even yesterday when we went through the whole UK deal, NASDAQ was doing okay, it was kind of drifting lower. Then it went to Q&A, and again, he kind of focused on chips in China. Mm-hmm. So I think that's what's growing is. And I think, Jensen Huang's done a great job making sure he's talking to Trump and, expanding on what he thinks the chip industry needs. And it seems like the president's being open to suggestions and is going to allow chips to be sold to some countries where Biden had put some restrictions on at the last minute.
Is that a signal to you that tech is the sector that brings us out of this moment of market volatility?
Yeah, and I think it should be, right? I go back when we were very bullish at Academy Securities, kind of coming into this administration, we really felt there was going to be a focus on let's do things that are important for national security. Let's focus on producing those at home. We did think at home meant, some of our close allies as well. I'm not sure that's still on the table, but that's where we should get is build America, build that sort of thing. And I think chips is a huge part of that. So it's good to see that focus being brought back to it.
And how would you advise investors in terms of just thinking about investing in tech right now, but specifically investing in chips, given the weakness that we have seen in semiconductors?
I've kind of a little bit overweight for the first time in a while. I'm cautious. I don't want to do anything crazy, though. I really want to see how this weekend comes out, because I think I want to take some chips off the table, which is really hard, because the last time the president said to buy stocks, all you have to do is buy stocks, and 24 hours later you were rewarded with huge gains. I'm not sure that's going to be the case on Monday. I feel we could wake up to some disappointment. Again, to me, Trump's all about ebbs and flows, right? When things are good, he likes to stir it up. When things are bad, he steps back and calms things down. Things seem so good right now. I feel we're in that stage where we might get a disappointment, come into a weak Monday, Tuesday next week, and that's when you want to start buying again.
So is this moment in time the ultimate teacher of the lesson to be fearful when others are greedy and greedy when they're fearful?
Yes, especially, I think we learned that during Trump 1.0, and he's right back to the table, right? He got very aggressive on tariffs. The market hated it. He backed off. Now we're getting some deals. They're okay. The market's comfortable. We're back above Liberation Day levels. But I think he's kind of itching to let's push back. I want my agenda through. And he does believe that tariffs generate revenue. He does think it's going to bring back manufacturing. I'm not sure he's going to be right on that, but he does believe that. So I think you're going to see a pushback right now.
What do you think is the most overlooked defensive play in this market right now then, given that you kind of have to go against the tape in order to generate alpha in this environment?
I think you kind of want to own bond yields globally. I think bonds, again, there's some issues. I think we've had some selling pressure. The deficit's not really under control. But I think we do get this one-time spike in inflation through the tariffs. That keeps the Fed on hold. But after that, it comes down. And you look at real yields, 2.5%. Even if we get a small inflation spike, I think it's a really attractive level. So I want to own bonds. I actually like the muni space in particular. So for a lot of clients, we started buying back a lot of closed-end munis in my recommendation accounts for individual investors. I think the closed-end munis are interesting here. They trade at a big discount. That's where I want to put some money in and earn 6%.
Is that a sign of just how odd this particular moment is in financial markets, that you're talking to me about munis and international bonds? Meantime, the US dollar is still under pressure.
Yes, it's crazy. And when I talk to the large asset managers right now, so when I look at the hedge fund community, I think they're pretty much on balance, right? So they're no longer super bearish or super, they were overly aggressive. I do think they have all these, pairs trades on. And I think that's where you see the pain. And every day you kind of see like, why did this pair do this weird thing?
Right.
And it's because some hedge funds started getting stopped out or decided to reduce risk. And I think everyone's got to be very cautious. Liquidity is very low out there. And so it looks very active. But if any big trade comes through, it immediately moves that market up and down 0.5%. Not 2% like it was doing a couple weeks ago, but I think the market's overreacting. So I want to be nimble. I want to trade this a little bit and take advantage of kind of these pops and dips.
And when there is a pop, do you do what Bank of America's Michael Hartnett was saying this morning, which is essentially buy the rumor and sell the news? Do you sell any rally?
I think that's what we've been trying to do, is you sell the rally. And to me, this is all still going to come down to China. And what's as neat, and we're starting to talk a little bit more, is also budget 2026, right? Mm-hmm. That, to me, was ultimately going to be his prize. Can he deliver on that? It's starting to make its way through the process. That, to me, I think, and I'd really like to see that, because it can turn back to some domestic strategies where I feel everything we've been doing so far in tariffs has been very zero-sum game, antagonistic. We can, I think, do a lot domestically through that budget that could spur growth without causing all this friction for us.
Yeah, you mentioned three things that could move markets in the coming weeks here in the short term: China, chips, and that 2026 budget. Where do you see that netting out? You say it can move markets. Is it going to move markets in a way investors like?
I think right now where we're at, I'm slightly cautious. Again, I feel like everything's getting so well priced in. Mm-hmm. And the one thing that I'm still concerned about, and I don't think the UK did anything to address this yesterday, is I am concerned about American brand sales globally. That we have done such a thing that, U.S. brands were aspirational. And, this is probably a bit of a stretch, but you go back to the Soviet Union. Levi's represented freedom. And I think to this day, right, people want to be associated with American brands. They like the affiliation. It's aspirational. And I feel a lot of damage has been done to that by the actions we've taken against a bunch of these countries. You've seen, tourism is way down. You've seen some other brands. I think Tesla most noticeably had German sales were way down. Is that a trend? Is that a one-time bump? I don't know. I'm a little bit suspicious that with 40% of S&P 500 earnings coming from foreign revenue sources, that could be a bit under some pressure, and that we're going to see lackluster sales of U.S. brands globally for the foreseeable future.
And how can you put that toothpaste back in the tube?
Right, and I think that's a very different thing. So it's one thing for the leaders to negotiate trade deals, but when people go to the store, are they still thinking like, I want to own this brand because I like it, or do I not want to own this brand because now I feel America's treated us unfairly? And I think that's a risk that's not being priced into S&P 500 earnings.
Really important context there, Peter. Thank you so much. And I know you're going to stay with us for the hour for more context, so appreciate it. Let's move to the Federal Reserve. Chicago Fed President Austin Goolsbee is delivering opening remarks at a Fed event focusing on perspectives from the Midwest. We're following his commentary on a busy day of Fed speak. We've already heard from Fed Governors Michael Barr and Adriana Kugler, as well as Fed Presidents John Williams and Tom Barkin. Joining us now with the highlights, Yahoo Finance Fed correspondent Jennifer Schomburger. Jennifer, what have you heard so far this morning?
Good morning, Maddie. Both Fed Governor Michael Barr and New York Fed President John Williams warning that President Trump's tariffs are expected to lead to higher unemployment and higher inflation, as well as slower growth. These comments echoing Fed Chair Jay Powell's earlier this week as the central bank held rates steady. In a speech in Iceland this morning, Barr said the Fed could be in a difficult position if we were to see both rising inflation and rising unemployment, though he noted it's too soon to know how tariffs will impact the economy because we don't know the final rate levels yet on tariffs. Like his peers, he believes interest rates are at a good level right now to pivot as things unfold. Now, Barr sees higher tariffs leading to disrupting global supply chains and creating long lasting inflation. He anticipates businesses will have to change where they source parts for their products, which will take time for them to revisit and reroute. He warns that big changes in global trade networks could mean the failure of some small businesses, as he says they have less access to credit and do not have multiple sources for supplies. Now, speaking at that same conference in Iceland this morning, Williams said that we are experiencing a great moment of uncertainty and change, and that uncertainty is a defining characteristic of the economic landscape for the foreseeable future. He stressed the importance of maintaining inflation expectations amid this uncertainty. Williams says he personally expects considerably slower growth this year, and while the general view is for higher unemployment and higher inflation, the Fed doesn't know the exact mix of that and how that might play out, as well as the time horizon, and thus it makes it difficult for them to set monetary policy preemptively. Later this morning, we will hear from Fed Governor Chris Waller, and this evening from Cleveland Fed President Beth Hammack and St. Louis Fed President Alberto Musalem. Back to you.
Jennifer, thank you so much, as always, for the great overview. Coming up here, a lack of March Madness upsets weighing on DraftKings. CEO is here next with more on the state of the sports betting business. Stick around for that conversation and more on Catalysts.
The S&P 500's longest winning streak in 20 years, it stalled out earlier this week, raising the question from investors. Was this just one of those flashy short covering rallies or the start of a race to fresh all-time highs? I'm Jared Blickery, host of Stocks in Translation. Well, today I have two bearish signals and two bullish signals, and we're going to go through this. But first, I got to get to a definition: market technicals. Market technicals analyze stocks and markets using price action, chart patterns, and technical indicators. And first up is the 200-day moving average, and we're going to look at the kahuna, the S&P 500. And there's that 200-day moving average in blue, and you can see we've been camped out underneath it for about 6 days. Until we get over that, and it wouldn't take much, I still land in the bearish camp. So we're kind of on the razor's edge here, and we got to move along, because now I want to get to sentiment. And the definition of market sentiment is the collective attitude of investors toward financial markets driven by optimism, which is bullishness, and pessimism, which is bearishness. And for that, we have a number of examples. We have surveys and polls like consumer confidence and consumer sentiment. We have fund flows. Where is the money flowing, as opposed to what are just the prices? We have market internals and breadth. For example, how many stocks in the S&P 500 are advancing or declining at a certain time? Social media speaks for itself. Derivatives and options, we're going to circle back to that in a second, but then we have insider activity. What is the C-suite doing? Are the CEOs buying their own stocks? And then new ETFs. Takes a long time for these products to come into market, and sometimes it's a contrary signal, very much like magazine covers. And we're going to come back to those too. But I want to stick with derivatives and options for just a minute here, and I'm going to take a look at the VIX. And yes, the VIX is a sentiment indicator here, and here we see it is still in the low 20s. And what I want to point out is that this is a 6-month chart, first of all. Earlier last December, we did have a little bit of a hiccup in the markets. It was a Fed announcement that came out a little bit hawkish, but it was the elevator up and an elevator down. It was very quick. But what we're seeing this time, and I'm going to put some candlesticks, you might have to squint, it's of a different character. It took a while to get up there, and it's taking a long time to get back down. This tells me, as Steve Snosnick likes to say, the VIX is not a fear gauge. It is a kind of a barometer of institutional hedging demand, and we're seeing a lot of uncertainty in the institutional space. So there's other bearish arguments, but now we want to move on to the bullish ones. And here is history. I like history. Seasonality is one of those. This is not seasonality, by the way, but what happened in April was really interesting. We saw the S&P 500, it was down 10%, and then it was up 10% in 1 month. This has happened 35 times since 1960, and over the next few months, even to the quarter, it does get a little bit dicey at times. We could actually see a return to those lows that we saw, but what's very bullish for me in the longer term is that 1 year out, 83% of the time, we were up with median returns of 14%, and I think that would be welcome from investors this year. Now, here's my second bullish argument, and this might be a little bit contrarian. Here's a Barron's cover from over the weekend. Where did the bulls go? So this is a clearly bearish take, but a magazine cover, kind of like a new ETF launch, it takes a while to produce, and it's kind of a stored up, pent up sentiment as to where the market might be not going. And so we see this play out in different ways. I would also draw attention to the fact that they're trying to make sense of Palantir's lofty price. That was just days before the price crashed 10%, which was the biggest drop in the year. So you put it all together, we're having some mixed signals right now, but we are on that razor's edge, and we can flip pretty quickly into bullish or firmly bearish territory. So tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. DraftKings missing first quarter expectations and cutting its full year revenue forecast. Still, revenue rose 20% from a year ago. The sports betting company says a lack of March Madness upsets kept it from raising its 2025 guidance. Joining me now, Jason Robbins, DraftKings CEO, and my Morning Brief co-host, Brad Smith. Jason, thank you for being here this morning. Let's start on the guidance. I'm really interested in getting some clarity from you on this. You said you would have raised it if not for unusually customer-friendly outcomes during March Madness. Can you break that down for us? Should investors just always expect your guidance to be driven by game outcomes?
Well, not always. I think in this case, we had a pretty historic March Madness. It was only the second time ever that all 4 number 1 seeds made the Final Four. And in addition to that, the first time ever that happened. And you had 3 number 2 and 1 number 3 seed in the Elite 8. So really a tournament where favorites were winning. 82%, in fact, of the favorites won. So that was actually an all-time record for March Madness. So I think it was a bit of an anomaly. We've heard theories like NIL may be driving more of that type of thing in the future. So obviously the models will have to take those sorts of things into account. But I don't expect that kind of favorite run to happen most years in March Madness or in any sport for that matter. But it does happen sometimes, which is part of the great aspect of the product. Customers can really go on winning streaks on things like that, which is great.
So then let's talk about what you are anticipating regardless of game outcomes, especially for the next year here. Sales and EBITDA for Q1 did miss consensus in part due to gaming taxes, among other potential headwinds, among a macro uncertain environment here. How are you thinking about the health of the consumer and the impact that could have on your business in the quarters to come?
Well, we included some material on this, and because we knew this was a question on investors' minds, so we included some material on this in our earnings release. And it's pretty clear that gaming and online gaming has also really shown resiliency through macroeconomic downturns. We took some data from 2008, the Great Recession, and we saw that obviously didn't have U.S. online gaming at the time, but it was widespread throughout Europe, and it grew quite nicely through that period. So that, in addition to us looking at our own metrics and seeing very healthy customer metrics across the board, and we analyze everything, really gives us confidence that we are pretty resilient to any economic environment.
With that in mind, how's that factoring into the guide right now, Jason? And great to speak with you again, especially as we're in this period where we've heard TV ratings are strong for the NBA playoffs right now. How's that flowing through to DraftKings?
Well, strong ratings usually lead to betting and vice versa, so those are good things for us, and hopefully that'll continue. The NBA playoffs obviously has been off to a fantastic start with these games, lots of great close games. My Celtics haven't come out on top so far, but still have a lot of way to go, so we'll see. But really, it's been a great quality product as we expected, and the betting is following.
As a Philadelphia fan who lives in New York, it's been quite rough for me as well, Jason. So I somewhat share your sentiments.
I can imagine.
There. So all things considered, as you're thinking through the sports events over the summer that are going to be the key drivers for DraftKings business, as we're now in a summer that is going to be Olympic-less, but still potentially have some other major catalysts for the business, what would be those key drivers from how you're looking out into the next 3 to 6 months?
Well, obviously, baseball is a big deal during the summer. It's our biggest sport. We're really happy to see that in April, baseball was up 16% on handle year over year. Live handle was up 36% year over year. So really strong metrics on both fronts. So hopefully that'll continue through the summer. We also have a lot of great enhancements we made to our golf products, our MMA, UFC products, and many other sports that'll be occurring during the summer as well. So definitely not the most active time of year from a sporting perspective, but still a lot going on the sport calendar, and we're seeing great customer metrics.
One thing I'm just personally interested in as a markets nerd more than a sports one, Jason, is whether or not the market volatility that we saw over the last quarter is a potential headwind for your business. In the Venn diagram of sports fans that are also interested in financial markets, does market volatility that encourages some riskier investing behavior like options trading, for example, prevent you from having those customers be more active on your platform?
We haven't really seen that. It's something that we talked about. I do think there's a bit of a difference, even though I'm sure there's some overlap in the customer. There is a different segment that I think is more into that. But certainly, it's something that we are keeping in mind. And, anytime, regardless of the reason that a customer has less discretionary entertainment income, that's always a factor. And I think, you can look at that across the board. But again, for us, we've really not seen, and nor has the industry ever seen, any of the macroeconomic factors out there affecting the numbers. It's always been pretty resilient to any kind of economic downturn. So I don't really expect that to be play out differently here, but it's something that, of course, we'll keep an eye on.
And I want to go back to the tax question that I mentioned earlier. Have you had any conversations with legislators over the past quarter here about what any changes to tax regulation in particular could look like going forward for the business?
Well, we're operational now in almost 30 states, so there's always going to be some of that going on in any state. We're obviously educating and helping understand that there's still an illegal market out there. There's still other options like federally regulated prediction markets. So we have to be taxed fairly if we're going to be competitive, and I think most states understand that.
As you're thinking about your average revenue per user right now, and ultimately $108 in the first quarter of 2025, 5% actually decrease compared to the same period in 2024, where do you see the opportunities to extract more values on a per user basis, knowing that users are, as Maddie was saying, being more discerning or looking across their spending and their finances and trying to figure out, how much do I actually realistically have to gamble or continuously wager versus a period where they might have a little bit more discretionary dollars?
Well, the reason that it was down was really those sport outcomes. And, that just means customers were winning, which I think is a good thing for long-term health. If you look at our handle, as we noted in our call, we were up 16% year over year, which is the amount of money wagered. So that's something that we look at more in terms of the overall spend of the customer. Obviously, outcomes can happen, and that can drag down, if you have a quarter like that, the average revenue. But those quarters, even though we've had 2 in a row now, they tend to be more of an anomaly. We haven't had a string of 2 quarters like that ever before this. So, great thing that customers were able to win, but also over time, those metrics will normalize. And we're really looking at the fundamental customer metrics, like how often are people playing? What does retention look like? How much are they spending?
And I know in the past you've talked about how sports gambling is not an investment tool, but I wonder how you think about sports betting as an investment tool going forward. Do you see this as a market for investors to really and potentially gain some revenue in their personal lives moving forward?
No, I don't think at all. I think it's an entertainment product, and people who bet don't expect to win over the long term. I think that there will be streaks like this where certainly there are customers that will make a lot of money, and that's a good thing. But I don't think people should look at it at all, and certainly don't as a long-term investment tool. Certainly it's an entertainment product.
All right, Jason, thank you so much for making the time for us this morning. Jason Robbins, DraftKings CEO, and our own Brad Smith for the conversation as well. It's now time for some of today's trending tickers. We are watching this morning NVIDIA, Cloudflare, and Affirm. First up, Reuters is reporting NVIDIA is planning to produce a downgraded version of its H20 chip for sale in China. NVIDIA planning the new version to get around U.S. curbs on chip exports to China. The company reportedly planning to launch the chip in July. NVIDIA CEO Jensen Huang said earlier this week that China's AI market could be worth $50 billion, and it would be a big loss to lose access to it. I'm still here with Peter Tchir, my guest host for the hour. Peter, how are you thinking about NVIDIA's movements here? Because it seems like any export control that's thrown at this company, they find a way to manage around it. What does that signal to you about the firm?
I think they're doing a great job. And, when I look at Trump and we analyze, he does value personal relationships. You see Jensen seems to be in D.C. a lot. He is trying to make this a personal relationship, which I think is the necessary thing. That's how Trump responds, how he deals with. We go back, one of our generals worked with Trump 1.0, and Abe from Japan learned to play golf specifically so he could hang out with Trump and play golf with Trump. And that actually worked very well for Japan back at the time. So I think he's taking all the right steps to navigate this as well as we can. And it is this trade-off, all the chip industry, we need to sell products to China, but we also need to make sure that we bring and retain the superiority, particularly in AI, here. So that's a balancing act. I think so far he's managing it fairly well recently.
All right, so learning to play golf, still a good business investment moving forward here, Peter. Next up, we are going to talk about shares of Cloudflare popping after the company reaffirmed its full-year forecast. In the first quarter, the software company reported a year-over-year sales increase of 26% and maintained its expectations for full-year revenue growth of 25%. The shares are up over 7% at the moment. And what's interesting to me about this name, Peter, is that I continue to hear investors that I talk to talking about the importance of looking at software versus hardware amid the tariff-driven policy concerns. How are you thinking about that?
Yeah, we think AI is here, it's continuing to grow, but the big part is people are realizing AI is only as good as the data that you can feed it. So I think there's going to be a continued growth in how do we build out the data, how do we make sure this data is useful for AI, and it's kind of this interesting cycle. And what's been encouraging for me is over the last 6 months or so, you're hearing more companies talk about how AI has helped their business be more efficient. And that whole first wave, everyone just talked about the hyperscalers, and it was the companies that were generating the AI product that were making all the money. Now it does feel like you're starting to get some of those beneficiaries at the corporate level, so I think that continues that spend. So I think this continues to grow. It may be overbuilt here or there, but I think the trend is in a few years, without a doubt, we will have more data, more software, more things being applied to that.
All right, well, finally here, let's take a look at shares of Affirm falling after the company reported weaker than expected guidance. Shares falling despite Affirm adding 1.8 million customers in the quarter. The company also announcing a new partnership with Costco and an extension of its partnership with Shopify through 2028. But the shares are down 11%. That disappointing guidance really hurting the stock here. And it also makes me wonder if there's a lesson about the health of the consumer right now, given Affirm is obviously attached to buy now, pay later. And there's questions, to say the least, about consumer health.
Yeah, I think that it falls into that camp right now where you look at auto delinquencies. All these things are kind of increasing. You're looking at, I think you guys did a segment earlier, restaurant sales. There's all these signs that the consumers tapped out a little bit. And buy now, pay later has been this phenomenal kind of relatively new invention. It's not very well regulated. It's not part of the banking system. So it's hard to tell what is out there, how the risks are, and how the consumer is going to respond. Because I think it existed a little bit with COVID, but at that point, the government was so quick to support the consumer with checks and low interest rates that I don't think anything got tested. So we might see this industry tested a little bit if the consumer slowdown is real.
That's a really great point, to make sure that you're looking at names that didn't just survive because they got stimulus. Make sure you're looking at some of those fundamentals in a world where we may not be getting any saving from the Fed or from stimulus more broadly. Peter, thank you so much. Great insights as always. And for our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, let's look at where things stand between the U.S. and China with trade talks set to begin. That's next when Catalyst comes back. Here's where things stand between the U.S. and China amid the ongoing trade war. The U.S. has a 145% effective tariff rate on all goods from China. China has a 125% rate on all U.S. goods, though it's reportedly made some exceptions for certain goods. So how did we get here? One of Trump's key promises on the 2024 campaign trail was imposing 60% tariffs on all Chinese imports to the U.S. He took early action in February, adding a 10% tariff on Chinese goods, which he raised to 20% in March. Then, as part of his April 2nd Liberation Day push, Trump announced another big hike, bringing the cumulative rate to 54%. China responded with a 34% tariff on all U.S. goods. In the following days, both sides continued to ratchet up rates. On April 9th, 1 week later, Trump paused tariffs on several other trading partners for 90 days, but boosted China's rate to 145%. China hit back with 125% tax on U.S. goods. Both the president and members of his administration have hinted that China tariffs could come down significantly after this weekend's talks. President Trump on Friday posted on Truth Social that an 80% tariff on China seems right. The Trump administration is weighing tariff cuts, with talks set to take place between the two nations this weekend. Bloomberg reporting members of the administration are targeting a 60% tariff rate, while President Trump said 80% seems right. The president adding that the final rate would be up to Treasury Secretary Scott Bessent. Bessent, joined by U.S. Trade Representative Jamieson Greer, will participate in talks with Chinese officials on Saturday. With more on what might come out of those negotiations, Philip Luck, Economic Program Director at the Center for Strategic and International Studies, and former Deputy Chief Economist at the U.S. Department of State under the Biden administration. Philip, it's great to have you this morning. What is your expectation for a tariff rate that we can anticipate coming out of this meeting, if any?
I mean, I don't anticipate anything to change out of this meeting right away. I imagine this to be a meeting where they start to describe where they might want to go eventually. I think both sides are indicating they're pretty far away from changing anything. And I would imagine that the PRC would want pretty substantial change to this rate if they were going to lower their rates at all. I would also say that, both sides seem to be wanting to have the other one make the first move. Largely, I think it's really good that they're talking, so we can start to move away from these incredibly high tariffs that are going to be very disruptive to both economies.
How optimistic are you that we actually are going to get that lowered rate, and what is that timeline potentially going to look like?
I don't know how optimistic you should be here. I mean, look, we're already at a rate where you have tariffs that are way higher than you could ever imagine for a reasonable economic policy. So we didn't get to the place where we are following sort of logical progression of activity. I would also note, your indication of sort of how we got here, which is actually very, very helpful, indicates that, we got here through a sort of back and forth of lobbying of tariffs. So, it's going to be hard. The trade wars are hard to unwind. They're pretty easy to start, but they're hard to back off from. Nobody wants to make any unilateral concessions, so you have to really negotiate for a long time. So, I think we're going to have high tariffs for a while. If they really want to remove these, I mean, the Trump administration could take these off tomorrow if they wanted to. They haven't seemed to want to. And I don't think that we're going to have tariffs that are going to be substantial on the PRC without them having substantial tariffs on us.
And Philip, my guest host, has a question for you.
Yeah, one of the questions I had is, where do you see us headed on rare earths and critical minerals, right? That seems to be a subset of the whole negotiation, and it feels to me a very important one.
I couldn't agree more. This is something that I think is sort of underappreciated. Look, I mean, there's a reason that the last administration passed the IRA and invested an enormous amount in these technologies, because the Chinese have a stranglehold on the processing and mining of these rare earth minerals. That's not just rare earths, which despite their name are actually not that rare. It's also things like graphite, gallium, germanium, antimony, things that go in everything from semiconductors to brake pads to bullets, right? These are really important components. They have the ability to really clamp off the supply of these. Producers have some stockpiles, but some of these things you can't even stockpile that well. So, I would imagine that hopefully there'll be some sort of, again, backing off. But we do also need to realize that this is a capacity the PRC has. They have the ability to put substantial pain on the U.S. economy through their leverage in the space, just as we can put pain on their economy through leverage that we have. So we do need to be sort of entering these conversations with that in mind.
Yeah, that makes sense to me. It's been one of the things I've been a little bit surprised that we haven't made a bigger effort to be able to process and refine these, because that to me is the missing component, right? It's not the minerals themselves or the extraction, it's the processing. And to me, we should have started that on day one here to try and move away. And I know Biden did some of that. What else do you see kind of in terms of the ability? Does China, who has the cards? Is China really prepared to, play nice, or do they have their own agenda and they're happy to stretch this out? Do you have a good sense on that?
Yeah, I mean, I don't think anybody seems to be in the mood to play nice necessarily. This hasn't been an especially friendly competition so far in this administration. Look, I think, the PRC, they don't have necessarily the political pressure that we do in a democratic system. So I think that they think they have more leverage than I think we're assessing they think they have. And, we can certainly see from the COVID lockdowns, they can keep policies in place for a long time, even if they are not in their direct interest. So I wouldn't bet against the PRC being able to retain some level of this policy. Look, I think we're, from everything we're hearing, we're weeks, if not days away from shortages here in the United States. I think the PRC knows that. So I think that's also something in their calculus.
Philip, thank you so much. Great context ahead of a very important weekend for our investor audience. Really appreciate your time.
Thanks a lot.
Let's take a look now at the major averages because it does appear that we are dipping into the red this morning. Your S&P is off about 0.3%. Your tech-heavy NASDAQ also off about 0.3%. Taking a look at what's moving, the second biggest laggard in your S&P 500 is the tech sector. That sector specifically is off about 0.6% this morning. And taking a look, Nvidia does appear to be pushing down those shares. It is down by about 0.5% at the moment. Of course, your tech-heavy NASDAQ also taking us down just a touch here. It is off about 0.3%. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. Coinbase announcing a landmark deal to acquire crypto options platform Deribit for $2.9 billion. This announcement comes amid a wave of M&A excitement unleashed since President Trump has taken office and appointed David Sachs as the White House crypto czar. Joining me now, we've got Peter Christensen. He is Citi's fintech analyst. Peter, great to speak with you this morning. Talk to me about this deal from Coinbase and how you rate it. Do you think that this was the right move?
Absolutely, and thank you, Madison. Great to be here. I think part of Coinbase's mission is really to scale its liquidity. At the end of the day, it comes down to liquidity, because that's going to be able to draw more capital and have the lower fees and certainly access points. And Deribit is clearly a pathway towards that competitive advantage. First, it gives them more of an international footprint. That's something that Coinbase has been working hard on delivering. And then additionally, it enhances their derivatives capabilities for sure. Yeah. On top of a 800 billion of futures volume, they now add potential of roughly $1 trillion in options volume on top of that. So it's really helped them on the institutional side.
And what does it signal to you more broadly about M&A specifically within digital currencies?
Yeah, it's been interesting. There's been a lot of activity, and we hear of things constantly. I think we're entering a new era for the crypto industry. It'll be really interesting to see if traditional finance and crypto native firms come together, and also just from the crypto native side, how these companies scale. I think there'll be a lot of competition, which I think will be good for the sector, but certainly a lot of opportunities. We do believe, and we've written extensively on this, that there will be a lot more public companies and crypto native public companies to come out. And in our dealings and speaking with a lot of them is they don't necessarily need the money. What they really do is crave legitimacy. And they believe that Coinbase has had a bit of an unfair advantage being a public company, having publicly disclosed financials and CEO and CFO attestations. So I think a lot of crypto native firms want to close that competitive gap versus Coinbase.
All right, and my guest host Peter has a question for you as well.
Yeah, when you're looking at investment possibilities, are you focused on companies that are going to be very focused on, say, Bitcoin or maybe into XRP, Ethereum, or do you go really for things that are playing farther down in the kind of alt token space?
There's a lot of questions on what token sphere. I think a lot of where Coinbase should be focused. At the end of the day, I really think it's about utility. And that's the promise of what blockchain offers. There's tons of real world examples where blockchain can make a meaningful difference in the underlying technology, given its immutability, trustlessness, and ability to scale. In fact, we often hear about the combination of blockchain and AI. And it's not necessarily what AI can do for blockchain, but what blockchain can do for AI, which is super interesting. But I really appreciate Coinbase's effort in going after utility, less so on the speculation side, creating real world applications that can be used not just for crypto tokens, but for all sorts of technology. One area they're doing that is B2B payments. That's an area that we're very interested in.
And as the U.S. government, as David Sachs and them seem to be kind of pushing towards some sort of crypto reserve or Bitcoin reserve, will Coinbase and these other companies benefit from that? How do you play that? Is that a great opportunity in the public space?
Yeah, Bitcoin is a major component of Coinbase's financial model. I think they have a reasonable share in on-chain Bitcoin activity. Clearly, they have exposure by supporting the majority of ETFs that are out there. So no, it's really important to their model. In fact, I think it was demonstrated this quarter more than any. Bitcoin has actually performed fairly well compared to other tokens which have not, and still Coinbase produced some really meaningful results, and a lot of that was afforded by strong Bitcoin performance.
Yeah, and I want to turn to my guest host here on set with me, Peter Tchir, for this next question, because it's interesting. Senate Democrats on Thursday, they voted down that motion that would have allowed the taking up of that GOP-led cryptocurrency legislation, and there's some concern about whether or not that is going to be a blowback. But you rightfully point out that the powerful figures of the administration, President Trump himself, obviously are very pro-crypto. Do those sort of intermediate headlines matter in terms of how you talk to clients about their Bitcoin allocation?
I don't think so. Right now, I think Trump hasn't really taken a full bite at the apple to get this thing. You've got David Sachs there. You've got his own family very involved. Yep. Howard Lutnick's firm, Cantor Fitzgerald, which you had to step away from, they're very involved in the space. I think even Bessent talked about how the stable coins are huge buyers of T-bills. So I think this administration really views that ecosystem as important. So I think they're going to push through and find ways. And I would not bet against Trump finding a way to get something done. So I think the next thing is up. I think we can go above the $105,000 highs wherever we got on Bitcoin. I think it's the wrong step. I don't think the government should be messing around as much as they are, but it's not for me to say what they're doing. I'm here to figure out what they're trying to do. And I do think if they have that success, you will see a lot of the red states in particular follow through, and you'll see crypto kind of make its way into public finance much more. And I think that pushes it higher for now.
And that's something that investors should be keeping in mind. If it's an asset that you see going higher, then maybe it's one you want to get into. Peter Tchir, thank you so much. And of course, thanks to Peter Christensen for joining us. Appreciate it.
Great, thank you.
Thank you.
Let's get a check on shares of United Airlines. The company erasing gains this morning following an ABC report that Newark Airport radar screens suffered a brief outage. Newark, of course, is United's biggest hub. Now, the outage comes after travelers have experienced hours-long delays and other hardships amid FAA staffing levels, runway construction, and technical issues that have thrown a serious wrench into operations at the airport. United Airlines is waiving change fees and fare differences for flights out of Newark between May 6th and May 17th. Passengers are also advised to subscribe to flight notifications and monitor flight status before arriving at the airport. You can see those shares down about 1.5% as part of this ABC report, and part of why we might be seeing a little bit of this action here, reporting that air traffic controllers could be heard telling a FedEx plane that their screens went dark, asking the aircraft to tell their parent company FedEx to put pressure to get the problem fixed when it comes to some of the air traffic control challenges. Of course, this is something the president also mentioned this week, that he is efforting fixes to this as well, amid the Department of Transportation announcing plans for a new state-of-the-art air traffic control system amid what they call an antiquated system that is currently in place. We're going to have much more ahead for you here on Catalysts. U.S. stocks have rebounded from the losses we saw following the president's April 2nd tariff announcement, but according to one financial advisor, sentiment isn't quite bouncing back. Our next guest saying some of the sentiment among clients that she's seen is reminiscent of 2008. I want to bring in Jamila McClooney, Black Wealth financial advisor for this week's FA Corner, brought to you by Invesco. Jamila, great to have you this morning. Tell me what you're hearing from clients. What is the sentiment that you're sussing out?
Great to be here. There's a lot of fear, the same fear and anxiety, the uncertainty, and just avoidance that feels very reminiscent of 2008 after the housing market crash. Obviously, a different reason and result that's happening now, but it's the same type of fear. They don't want to open statements. They don't want to look at their accounts. They just want to avoid it, kind of blind optimism, and hope that it goes away.
Yeah, I think great point. The people have to look at their accounts. It's the reality of the world. You know, the one thing, to me, it feels like we're in this world where Trump wants to change the world. He wants to change how business is conducted globally. And it's easy for me to see a world a year from now where we're either up 25% or down 25%. But to me, if we're up 25%, I'm comfortable missing some of that rally because my job will be good, my house will be good, my family's probably well off. I'm more concerned where if it's down 25%, not only did I lose my portfolio, I've maybe lost in my job, I've lost with the family, I've lost with that. Is it right to kind of think that way, or is that being too conservative?
I believe that's a great way to look at it because, like you said, maybe we don't catch all of those big gains But if we have the security around the things that can help us over the long term and keep us financially secure, then we're okay with giving that up. So it's a good point to kind of look at the overall picture.
Jamila, we got to leave it there. Thank you so much for joining us. Appreciate your insights, and interesting to hear some of that pessimism that you're getting in from clients given the comparison to the global financial crisis. Really appreciate it. That was this week's FA Corner, brought to you by Invesco. Coming up, Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith. He's going to have you for the next hour, so keep it here for more.